Hi everyone, this is Pete here. So today we're going to look at the latest statement from Chairman Powell. And what did he say that caused the market to crash close to 3% just in the last 2 days? Let's take a look at it. Alright, so recently Chairman Powell has been playing yo-yo a lot, right? So previously he was talking about the interest rate is going to continue to cut because even with better economic data, he feels that they should be still on track. But right now, in the latest statement, okay, you can see over here, this is the YouTube video from Bloomberg. He is saying that, hey, the Fed policy will likely need more time to work. Okay, so what does that even mean? So when someone says that they need more time to work, they are actually referring to possibly not cutting rates. Now, this caused the market to have a huge reaction last night as well, right? And actually started just last Friday. Now, when was this statement given? So actually, if you dive deeper into the statement, actually Chairman Powell gave this during one of the forum that wasn't even about the US economy, okay? It was about the Canadian economy. And the exact statement is this, okay? So I'll read to you. Last year, the rebounding supply supported US growth in spending and also employment, alongside a considerable decline in inflation, okay? But he said that the more recent data shows solid growth and continued strength in labor, but a lack of further progress so far this year on returning to our 2% inflation goal. So what is he exactly saying? He is basically saying that inflation has not come down as they expected, therefore a lack of further progress. And with that, it caused the market to have a huge reaction. Now, it is not just Jerome Powell's statement, but I don't know if you know about this news, but the last few days, the situation in the Middle East has been escalating, right? It's not just Israel versus Hamas anymore. Now it seems to be Iran coming into play. So it caused the market to have a huge reaction. And on Friday itself, the Dow Jones fell by 475 points. And they say that this is the worst day since January. So this year, 2024, right? How much has everything dropped? Actually, if you look at the heat map, right? Everything is red, okay? It's crazy. Everything is red, maybe except for like a couple of them, for example, Nvidia. Now, Nvidia is one crazy stock that has not come down, okay? But today is not about Nvidia. Maybe I'll do a video on Nvidia soon. But the thing is this, for everybody that is screaming out there and saying, hey, the market has come down so much, the thing is this, I want you to take a look at the indexes, okay? And you can see over here, right? This is the S&P 500. So after we had a sharp decline in 2022, the whole of 2023 we were up, okay? And then we have a little pullback. And then the whole of 2024 so far, we are always up, right? This is exactly the same as NASDAQ, just with more volatility as well. So the thing is this a surprise to any of you for the market to have a little pullback? Okay, so today I want to talk about like how should you position yourself for this and what to expect going forward. Now, the first thing you must understand that price drawdown in S&P 500, right, is normal. It is 100% normal, okay? So if you look over here, this is from Bloomberg. They basically show you, right, the percentage of decline, okay, how many times it occurs, okay? So you can see over the last, I would say close to 70 years, okay, the 5 to 10% decline happened 84% of the time. And another 10 to 20% happens 29 times. So what does that mean? That means you would expect almost every year to have at least one or two 5 to 10% decline. And every 3 years, you will see a 10 to 20% decline. For all this decline, generally, how long does it decline for? It could decline for a month to 4 months on average, and it will take another similar 1 to 4 months to recover based on these statistics, right? If we look at another statistics over here, right, this is by Standard & Poor's and Charles Schwab, right? They basically show you that pullbacks of 10% or more occur in 10 of the past 20 years, okay? So the S&P 500, right, had about 10% pullback, right? About 9.5% of the time. So that means every 2 years, you should expect something like this to happen. And I would say, if we look back at the chart again, we haven't seen this since 2022, right? So it is about time for us to see a little bit of pullback. Later, I'll move on to the charts to illustrate one of my predictions, okay? Right? But the good news is this. With all these recent pullback, right now, when you look at the fear and greed indicator, now this is a really good indicator. How to use this indicator is very straightforward, right? I don't know whether Charlie Munger said this or Warren Buffett said this, but basically the gist is that the market tends to fool the majority of the investors. So if the market is very fearful, you should be very greedy, right? If the market is very greedy, you should be fearful. So what are we seeing here is that with the recent pullback, now the indicator is swinging towards the fear region. Okay? And in fact, just about a month ago and even a year ago, we were super greedy, right? You see the index is running at about 74 and 65 times super greedy territory. So it's good that now we're having a bit of fear. So as it gets to extreme fear, which I hope it will happen, that's when investors, retail investors like us, we should get greedy over here. Okay? Now, let me show you one more thing to allay your fear about the market, okay? Is that this year is also a fantastic year because it is the election year, right? So it's a US election year. Now, this is a statistics that's being done where they track the US stock market performance based on election years, okay? So honestly, if you look at it, right, all right, no matter who got elected, whether is it the Republican, which is red, okay, or whether is it blue, the Democrats, right, almost every year except for 1, 2, anything more, okay, 3, 4, okay? Since 1928, there were only 4 elections that resulted at the end of year, right? The S&P 500 is actually lower than it is. And out of these 4, take note, one is 2008, okay, global financial crisis. One is dot-com bust, right? Another one is 1940, where we just came out of Great Depression, and this was 1932. So if you look at it, right, over here it says, right, there's been 23 elections. So statistically speaking, right, what are the odds of the market being higher this year? Is 83%. Is 83%. Okay. In fact, if anything, between Republican and Democrats, you can see that the returns are actually Republican is better. Okay, so maybe let's hope that Republican will win. Okay, but this is not a political show. Let me go into the next page where I want to talk about this year so far, right? Which are the best performing sectors? Okay, so you can see the best performing sector for the first quarter, right, this year was actually comms and services, energy, infotech, financials. Right? This is something that very few people expected because people thought that, hey, if the economy is not going to be great, right, the interest rate is so high, why would, for example, financials be better? Okay? But if you look at the blue column, right, it is showing you in the last 12 months which has been the better performer. And you can clearly see that the best performer last year was actually comms and services and infotech. So these two were the one that had the largest drawdown recently. So once again, what does this show is basically the market is a balancing machine, right? Most of the time. When something is overextended, it will come back down. When something is over-dipped, oversold, it will also come back up, right? So for example, if you look at the blue color, actually energy last year did very poorly. But this year it did second, right? Just 1 quarter of energy performance already almost hit the last year's whole of year for energy sector. Okay? Right? And you can see last year consumer discretionary did really well, but this quarter, it didn't do so well as well. Right? So as you are investing in different sectors, what I personally do as a portfolio manager for my clients, right, is that I look at sectors that didn't do really well last year, and I ask myself, where can I find gems in this sector? Because there's a fair amount of chance that this will recover. Okay, so this is my investing style. And right now, when I invest for my clients, a huge bulk of the investment I actually put into financials. Right? So we are pretty on track. Hopefully, financials will become the front end. Now, the issue is right now, Jerome Powell is still saying that, hey, we're going to hold rates steady for much longer. And that created a lot of fear. So the natural question is, hey, will this cause the stock market to crash just because they hold the rates higher? Okay. So I found some stats over here, right? For example, you can see in the past, actually, if anything, right, when the Fed pivots, so what does a Fed pivots mean? When the Fed reduces rates, okay, you can see that over here when the Fed reduces rate, the market dropped by 35%, 58%, 51%, right, 27%, 48%, and 36%. So if anything, actually based on statistics, right, whenever there's a rate cut, we tend to see the market decline more than anything, okay? But honestly, data is like that. You can actually flip the data around and find more reasons. For example, actually what is not shown here is that there was actually quite a fair amount of moments where the rate hike, okay? For example, start hiking here, actually the market continue to head upwards as well, right? So I would say the rate cut or rate hike doesn't really change the stock market, right? The interest rate itself doesn't really change, but it is the rate of change, right? It is how fast this interest rate is changing. So the example I always use to share with my clients, right, is that imagine you are a business out there, because as investors, we are buying businesses. So as a business, when you are running your operations, you are actually trying to predict the future. For example, how much goods I should bring in, how much money I should borrow, right? So in terms of taking loans, the businesses just want stability, right? For example, if you tell me that the interest rate going forward is going to be 2% only, right? Maybe I'll borrow more so that I can bring in more inventories and sell more goods. But if I know that the going forward interest rate is going to be 5%, right? Then I know that, okay, I should plan my businesses around 5%. But it doesn't change anything because the 5% will apply throughout the whole economy. It's not my business that suffers the 5%, everyone else as well, right? So we'll just plan around the 5%. But the difficult thing is that if the businesses cannot forecast what is the interest rate going forward, imagine one moment is 2% and then a few months later is 5%, it is going to be very hard for businesses to do some planning and say, hey, am I going to be aggressive here or am I not going to be aggressive here? Should I take on loan or should I not take on loan, right? So that is the difficulty. And guess what? The stock market is like this. The stock market hate instability, hate uncertainty, right? So it is going to be the rate of change that matters. So actually with the Jerome Powell statement of not decreasing rate, actually I think that creates more stability in the market. There will not be so much speculation. Okay, and coupled with right now what we see in terms of the rates coming, the stock market coming down, I think that's a very healthy cycle as well. Okay, right? We need to see some pullback in this case. So the question is then, in this case, Pete, what else should we look at? Now, one thing I would say is not just to focus on what you should look at, but also focus on what you should not look at. And one important source of information that I feel most investors, okay, unless you are really trained to filter through the news, right, is the proper financial news market, okay? For example, if you look at one of the news last year, right, this was actually at CNBC, if I'm not wrong, right? The fund strat expert actually said that we expect the stock market pullback in early 2024 for these 4 reasons, yada, yada, yada. And guess what? He could not have been more wrong, because since then, the stock market, S&P 500, has climbed more than 10% just in the first quarter of this year. Okay, in fact, this brings about a really positive news, because when I research, hey, what does the stock market do? How does the stock market perform if we do well in the first quarter of each year, right? Okay, so in the past year, these are the years whereby they did better than 10%. Okay, so from 1954 all the way to this year, 2024. Okay, and for all these quarters that did more than 10%, right? The rest of the year return, all of them except 1 year was negative. Okay? All of them except 1 year was negative. That means there is a 91% chance we're going to see the S&P 500 end up higher, okay, than where it was at the start of 2024. But one thing I want all of you to take note is that the last column perhaps is the most important one. It is telling you the maximum percentage of pullback that happened for the rest of the year. Okay, some years are very muted, 4%, 7%, but there are some years where the pullback are as big as 14%, 34%, 19%, and 10%. So what does this mean? It means that when you are investing in the stock market, yes, while the overall average return in the stock market is 11% in this case, it doesn't mean it is 11% linearly. That means it's not like January 1%, February 2%, and then it adds all the way to November, then 11%. Right? It is not like that. The stock market is going to be volatile. And whoever can take the volatility and pay the price will receive the reward at the end of the day. But there are some people, right, who are going to be shaken out by the volatility, right? And that's where they will never see the fruits of their investment at the end of the year. Okay? Now, just to cap this off, I found another data over here that goes back a little bit further. And they talk about, if we don't talk about 10%, we just look at, hey, the year to date in February is more than 5%. How does the rest of the year look like? Okay? And you can see it's a sea of redness. A sea of greenness. Okay, my apologies, right? You can see almost every single year return positive except for 2. Right? So your percentage increased to 92.9%, almost 93% of success that we're going to see S&P 500 at the end of this year going to be higher than start of the year. Okay? So this is what gets me going. I think this is really, really positive. Alright, next up, I want to go to the charts. You can see over here, this is the Nasdaq chart, okay? And the Nasdaq chart has been really healthy. Ever since we came back from the 2022 drop, okay? The whole of 2023, we were up, okay? And right now, start of the year, we were still up, right? And how much have we gone up in terms of Nasdaq? Now, the S&P 500 went up about 10%, but if you look at in terms of Nasdaq, we are up close to about 8%. So it's actually quite rare for Nasdaq to underperform S&P, okay? So this is where it gets interesting, right? Previously, I talked about, I was not very much into technology, but if this dip is severe enough, right, I may consider start layering in, all right, dollar cost average in, right, into the technology sector. Now, the question is, how much will this pullback be? How far can we pull back? So if you take a look over here, right, I've drawn out the moving averages. Right, intermediate one will be here. This is the 50 moving average, but I think more likely what we'll see is that we'll see a proper pullback here to about the 100 moving average. And that's exactly what we saw late last year, right? Where the market, after a very strong run for the whole of 2023, it actually had a little pullback. And this pullback wasn't small as well, right? If you took the top to the bottom, this was close to an 11% pullback, okay? So if we were to look at 11% from the top of here, right? Where would that bring us? It would actually bring us right about here, right? Can you see that? Okay, right about the 100 moving average. Okay, so this is my, I would say, base case scenario. I think this is likely going to be the base case, right? If it goes to the 50 moving average, that's going to be the bull case. That means the market is going to drop. Okay, let me show you over here. Drop down and then head upwards. Okay, otherwise, this is my base case. My bear case is that if it drops down, okay, to the 200-day moving average, then it head up, okay? But if you just expand the chart a little bit, right, you look at the weekly chart, you can see that, we are so far away, right, from the 200 moving average, right? That was how much the 2022 did take place. So if it were to happen, it drops all the way here, wow, I will be super happy, okay? I will start to raise funds and start to add for not just myself and my investors as well, okay? If you look at the S&P, actually, I won't go through too much of S&P. It looks pretty much the same. In fact, one thing I will just add is that the market climbs on a wall of worries, right? So if you just zoom out your chart and you look at the past history, right, every time it has a dip, it will climb up, right? At a dip, it will climb up, but it will bounce off, like climbing stairs. So right now, it's exactly what is happening right now. We have a little dip, right? And we're going to climb up the stairs again. And to climb up the stairs, that means it's not going to be a straight line up. No, right? It's going to be up and down, up and down. So I really welcome this. I love seeing this. Now, as investor, I would say one key thing for you is that you need to mentally prepare yourself. When such moments happen, what you will see is that your portfolio value is going to drop, right? Don't have no doubts about it. In fact, my own portfolio, I saw when this initial drop, right, I saw close to a 2% drop over that one day. But is that something that should worry you? Right? It shouldn't, because if you're invested in the strong companies, right? I always tell my clients and my students is that if you're invested in the strong businesses, as we have, right? We are finding great businesses out there to buy. Later, I'm going to show you two that I'm looking at right now, okay? And they have such high quality earnings. But when the price dips down, should you be running away from the stocks or should you be running towards the stock? Okay. So in fact, as investor, if you see your portfolio value drop, okay, instead of having that fear and panic, I want you to have that sense of elation, right? A sense of happiness. Why? Because it just means that the good businesses right now are selling at a cheaper price. So take note, if you are an investor, actually anytime you see your portfolio drop, okay, it's actually a good sign. You don't want to see your portfolio value keep going up non-stop. That means if it's going up on a straight line or exponential curve, right? So for example, if the market keep on going up from here, like the S&P 500, right? And I think a lot of people wish that to happen. If it just does this, what does it mean? It's going to hit into a bubble eventually, right? And it's going to have a really, really hard crash. So we don't want that as well. Right? As an investor, what you want is periodically retracing to shake out all the weak investors, all right? Or in the crypto world, we say the paper hands, right? So we shake out all the paper hands and we buy in, and the rest of us, if it's a strong business, hold on to dear life, right? Hold on to the right, and at the end of the day, you will reap the fruits of your reward. Okay? Another way to help you psychologically and mentally is when I work with my clients for the portfolio investing, right? I also talk to them about their real estate. And real estate is actually a very good example for this, because in the real estate world, right, it's very different from the stock market. In the stock market, when price dips, people run further away from the stock market. But in the real estate world, hey, if anyone comes to your house and you know that your house is worth, for example, $3 million and someone just lowball you and offer you $2 million, will you be panicking and run away from your house? You wouldn't, right? You would just slap the guy who lowball you and say, go off and you'll look for the next buyer. And that's exactly the mentality you should have, right? If you are a property investor like some of my clients, I will actually encourage you to have that mentality in the stock market. If you know that the stocks that you own in the stock market is as good a quality as the house that you have bought, right? You know that it's of true value. You know that it's worth a certain number of dollars. Then whenever the market reduces the asking price, is offering you a better price, instead of you panic selling back into the market, okay, you should be taking the offer from the market. Alright, so now let me go into two stocks that recently I was really eyeballing. Okay, I'll not explain to you why I'm eyeballing it, okay? Right, number one is actually Apple. Right, so you can see on the weekly chart over here, this is Apple. Right, it has been going on a trajectory that's up, down, very healthy, right? Then we have a pullback here, then we have up, down. In fact, the reason what we saw is that it has come back down to the 100 moving average. Okay, so let me just expand it here, right? So this is pretty interesting, right? And we see that the MACD is showing really good signs. The stochastics is really oversold already, right? And RSI, while it not at the bottom yet, but this is about as low as Apple went in the last couple of rounds, right? So you can see the last few bottoms, this is where as low as the RSI went. Okay, so actually we are already there. Okay, so I'm looking at opportunities to add to Apple. In fact, if you add on the daily chart over here, okay, let me just set it up, right? You can see that we are right at the previous support level. Okay, right? If I just draw the line over here, you can see that we are right at the support level, right? So to me, this is quite good. The only worry I would have, not in terms of valuation, but in terms of technical analysis, is that the 200 moving average here, it serves as a technical resistance. Okay, so if it can break through that, that would be great, right? In terms of valuation, I would say right now, Apple is just about the fair value. Okay, just about the fair value. I would say the fair value for Apple is about between 170 to 180. Now, a lot of times when people talk about valuation, they talk in terms of the absolute number, and I think that's absolutely rubbish, okay? Even if you go to Tim Cook's, right, you ask Mr. Tim Cook's, hey, Mr. Cook's, what do you think Apple is worth? There's no way the CEO could even give you an exact figure. Why? Because the value of the company depends on so many variables, right? It depends on future growth, product line that's coming up, right? Any future acquisition, so on and so forth. So what you can logically do as an investor is not to have an absolute number, because no one can be that precise. In fact, the saying goes, right, I'd rather be roughly correct than to be precisely wrong, right? So there's no point harping on a specific valuation. You don't want to do that, right? What you want to do is, hey, I think Apple is good value between, let's say, 180 to 170, this range, right? So if I can get somewhere between here, right, I'm in a good position, then I can start buying. Because if you only have a single valuation, what happens is that, let's say your valuation is 160. And if it comes down to 161 and it just hits upwards, you'll be killing yourself. Okay? Alright, so Apple is one company I'm looking at. Very strong numbers. In fact, I think Vision Pro is going to be a future strong product for them, but that remains to be seen, and I think that's a topic for another video. Okay? Now, another one that I really like that has been hammered down like crazy, okay, is actually Adobe. Right? Adobe has been suffering about the AI incursion into their businesses. Okay? But if you look at the finances of Adobe over here, okay, let me just go to look at the finances for Adobe. Okay? Right? You can see that the finances for Adobe actually is really strong, right? For example, if I look at cash flow, this is a very positive cash flow business, right? Right? Cash flow has been increasing over here. And if I look at ratios, you can see that in terms of return on equity, return on asset, return on investment capital, is a fantastic business as well. So when people are very worried about a business like this being taken over by AI and whatnot, right, I would encourage you to dig deeper, okay? So the thing is, we all know AI, as smart as it is, right, it still hallucinates, it still creates a lot of weird things. So nobody can just say, hey, AI, please go and design the house for me. The architect cannot just relinquish the role like that, right? If they do that, the house is possibly going to collapse after the construction is done, right? So what they will do is they will ask probably AI to create a base template, and they will still have to edit it themselves. So after that, what do they edit with? They still have to edit with Adobe softwares, okay? Now, a lot of people only know Adobe for like Photoshop, right? Lightroom, but honestly, Adobe does way more than that, right? It has a lot of software that's even for the commercial side that's being used, okay? So having said that, can you see that Adobe has come down really a lot, right? TA-wise, it definitely doesn't look great right now in terms of the descending trend, but in terms of valuation, this might start to look attractive in the near term. Okay, now another stock that I want to look at, just give you all one more before I go, is actually Mercado Libre. Now this is so-called the I don't really like to use this term, but I can't find a better term to do it. It's a very lazy way of labeling something when you say this is the something of something, right? So but this is technically, I would say, the Amazon of Latin America, right? They are basically doing what Amazon is doing in terms of delivery, right? In terms of sending goods to people. And right now you can see in terms of charts, okay, let me just draw the charts more clearly. Okay, over here. Okay, you can see that the charts over here, the support here is actually very, very strong, right? Really, really strong. Okay, if I draw on the weekly chart, you can see that it is right at the 50-week moving average, just about, right? So what I will do is I will just monitor a little bit. I want to make sure that firstly, a few things. Number one, on the technical front, it shouldn't break this 200 moving average and don't come back. What you don't want to see is this, right? And then you'll be in trouble. What you want to see is a breakdown and then it bounce up nicely. Okay, that will be fantastic. Another thing I want to monitor is in terms of the valuation. Okay, so let's take a look at Mercado Libre valuation here, right? You can see that in terms of the standard PE ratio, it doesn't look very cheap at all, right? But if you look at other indicators, for example, price to book ratio, actually looks pretty decent, right? Price to operating cash flow is also really decent. So PE ratio is not always going to be your best friend when it comes to investing in high growth businesses, okay? Because high growth business tends to attract high PE ratio. Okay, another one, EV/EBIT, you can see that it's fairly decent. All the while, the EV/EBIT has been really high, and right now it's at the lower end of the stick. Okay, the only thing that concerns me about this business is that the debt to equity is not low, right? It's over 100% over here. But otherwise, in terms of ROE and ROIC, this is a much stronger business. Okay, to give you a perspective, I'll just show you in terms of Amazon, right? What is the efficiency of the business? Okay, so if you look at Amazon, you can see that the ROE and the ROIC is a lot lower. Okay, and back in the days when C Limited was still competing with them in the LatAm environment, right? You can see that C Limited is totally not a type of business that I will go for in this case. Okay, alright. So these are the three stocks: Apple, Adobe, and Mercado Libre. Some of them are ready, right? For example, Apple is ready, but I would say Adobe and Mercado Libre, I will wait for a little while before I enter. So once again, just take note that anytime when we see a healthy market pullback, you should not be panicking. You should be thinking about how you can add to the position, okay? And that's all I have for you for this video. Let me know if you like this type of content in addition to my real estate video, right? And I want to make sure that my community can benefit from both investment class as well, right? Let me know if you have any questions below and what are the other types of stock market video or real estate video that you would love to see, and definitely I will do my best to produce them for you. Okay? So that's all I have, and I'll see you guys next time.